Good morning, one and all present here. This is Amit Kumar Singh, and welcome to the fourth session on risk analysis and capital budgeting. In this fourth session of risk analysis or capital budgeting, which is basically of a subject called risk management and derivatives. So, we are first trying to understand the risk management, and this risk management, what we are discussing here right now, we are talking about this risk management on the concept of regard of a corporate. So the first chapter of risk management is all about how we can understand the application of risk management on corporate point of view, and then gradually we'll go further in the next sessions and we'll try to understand the risk management basically for individual point of view. So when we talk about risk management, uh, when we talk about risk management for individual point of view, then probably we use the application of derivatives. So the derivatives which can be for OTC market, or it can be used for the exchange, from long time is being used as an instrument and for hedging the risk, and probably derivative as an instrument is very popular in the present global era, where we can see a lot of ups and downs in the present economic world. So recently you saw that the gold prices has crossed 55, 56,000 rupees per 10 gram. So then again, the gold prices become normal. Every day when you observe the stock market, you see so much volatility happening in the market. And if you read newspaper to understand the reason why that volatility is happening on the market, no one can predict that reason. So with that, you can understand how volatile the environment around us has become. So the one of the very good instrument which can help us to save ourselves from this much volatility is the derivative. At the same time, a derivative as an instrument will help all those individuals who want to play with this risk. There are many individuals who love to take risk and they want to trade on the risk. So like there is something called VIX trading, volatility index trading, that you can do on a stock market to take advantage of the volatility. So volatility as a term, when we talk about volatility as a term has emerged previously with the term of standard deviation. So previously, whenever we used to use the term called volatility, so that was basically means standard deviation. But gradually, as we go further and trying to understand this term called volatility, now volatility means VAR, value at risk. So volatility, time by time, the definition of volatility has changed. Earlier, we used to talk volatility as something called historical volatility. Now, when we say volatility, volatility means implied volatility. Implied volatility means which has not happened. Implied volatility means which can happen. So, which you can imply based upon the present economic situation. So, as those students who really like risk management, who want to make career in finance, I believe you all of you are here. You have taken specialization of finance. You want to make your career in finance. So definitely you should take risk management subject very seriously. So there are exams also there on risk management. There are exams on risk management, very famous exams. So which only focus on risk management. Either you can prepare for PRM. So PRM stand for Professional Risk Management Exam. So this exam, when you talk about this exam is conducted by a body called Premia. So this exam is conducted by the body called Premia. So this exam has 4 levels, and so one by one, like in level one, you study. In level one, you will get the questions of the finance, what you have studying in your MBA. That questions will come in level one. Level two, only maths will come. Level three, complete finance and maths together with case study will come. Then level four, again that would be case study based exam. Then the exam which is very famous for risk management is FRM. So FRM is the exam which is very famous and it is conducted by the body called GARP. So Global Associate for Risk Professional. So this FRM exam happens in two parts. So you can think these exams if you really are interested for risk management and all. In if you want to look for the exams, what is being conducted in India, probably you can go for the exams conducted by NSC. So NSC under NSC also, if you want a stock market broker or a trader, you can for in order to work on NSC, you can start with something called derivative dealer module. I have the book of derivative dealer module. If you want, I'll forward in your group. So you can start with very basics. If you don't know, you can write before derivative dealer, you can write derivative basic module also by going to NSC website, and in there you can type NISM modules. NISM modules you can type NISM modules, NISM or NCFM. So earlier it name was NCFM, now the name is NISM. So you can start with derivative dealer. So equity derivative dealer, better word would be equity because it focus on equity market. Going further, you can write more exams like based on commodity derivative. You can write exams on commodity derivative. Equity derivative is more prominent on NSE. Commodity derivative is more prominent on NCDX, National Commodity and Derivative Exchange, and MCX, Multi Commodity Exchange. Then you can write currency derivative. Then you can write currency derivative, and going further, if you want, you can write interest rate derivative also. Interest rate derivative is not so famous in India. uh, Altogether, people or individuals don't trade much on debt market in India, and that too on interest rate derivative. Very less awareness is there. Although NSE has tried many times to create awareness about interest rate derivative, but still interest rate derivative is not at all common for trading in India. So those who look for career, they can go for equity, commodity, and currency. Fine, that will make more sense to them. For knowledge point of view, also it will make sense, and at the same time, it will help you for your career also. You can see the present economic world where getting job is getting difficult day by day. So if you prepare, I have the books more or less. I believe I have the book of all these exams. If you want, I can forward the book in your group. I'm not sure about like which all I have, but still I have these books. I need to search for that soft copy of these books I have. If I get, I'll put in your group. You can prepare for this exam. The cost of the exam is not so much. It's hardly 2000 rupees or somewhere 2000 rupees. You need to do registration on NSC website, and then you get an exam date. You need to choose exam date slot of the exam. The exam, my time used to happen on Fraser Town. I don't know the where it's happening right now in Bangalore. So that you can figure out from the NSC website. So then probably if you prepare for this exam, it will give you a certificate. It will be online exam, and the moment you finish the exam, you get the scorecard, and very soon you will get the certificate for the exam. And tomorrow, wherever you go for a job for the brokerage industry, these certificates will help you a lot. So just an idea. FRM, like anyone who are really interested for derivative or who really want to make their career on derivative, they're very serious about derivative, they can prepare for FRM. But FRM again is very difficult. It happens in two parts. It is a world level exam. The cost of the book of FRM is still 5,000 rupees. Okay, so just an idea input I wanted to give you. Like I was very passionate for risk management during my college time. I have cleared CAIIB, a risk management exam. Right? So again, your wish. If you want, you can prepare for risk management. or if you're simply looking for passing in exam, then again, it depends on you people, where you want to see. Fine. So coming back to the question which I wanted to discuss. So I just gave you a brief overview that uh, how this how this subject is so important for you as a student of finance. So let's come back to the question. So as you know, the objective of these classes is to prepare yourself for the exam point of view. So we'll focus questions on exam point of view. So previously we have done questions which are important for your exam. So going forward, let's discuss one more question. This is a question where there's a company called Airborne Limited. It want to take advantage of the new government schemes of connecting smaller towns and want to purchase one turbo prop engine at the cost of 5 crore rupees. So there's a company called Airborne Limited, and what the company is planning, it is planning to buy one turboprop airplane, and the cost of this airplane is 5 crore rupees. So everyone understand 5 crore. 5 crore means 50 million. 5 crore means 500 lakh. And now that company, the Airborne, by the cost of 5 crore, it is buying an engine, and it has obtained permission to fly on 4 sectors. Now, the company has provided the following estimates for its cost and revenue. The cost of capital is 16%. Again, they have not given about the weightage of debt and equity. Like they bought this turboprop aeroplane with 5 crore rupees. So they have not given the breakup of this 5 crore rupees, how they arranged. They arranged all by equity or by debt or certain percentage of equity and debt. All that information is not given, so there's no discussion about WACC. So here it's given directly 16% cost of, so we'll take 16% as the cost of capital. And then it is given that the company depreciated assets over the period of, the company depreciated assets over a period of 25 years on a straight line basis. The cost of the company is 5 crore rupees. The cost of this turboprop engine is 25 crore rupees, and they're depreciating on straight line method. And there's no salvage value given. So I believe that salvage value, terminal value after 25 year would be zero. So probably if I ask you, then what every year what would be the value of depreciation? So that is nothing but that is 5 crore divided by 25. So 5 crore divided by 25 if I do. So 5 crore is 5 into 10 to the power 7 divided by 25. So 5 by 25 is 1 by 5. 1 by 5 into 10 to the power 7. So 1 by 5 into 10 to the power 7 is 2 into 10 to the power 6. So or I can say the depreciation is 0.2 crore. Okay, or 2 million or 20 lakh, whatever you can say. So the depreciation per year would be 20 lakh, and currently it is operating in 30% tax regime, and under the new government scheme it enjoys 100% tax waiver for the first 3 year. Okay, so I hope you are understanding this. So although the tax rate is 35%, but government is giving a relaxation to this company that for 3 year there would be no tax. What the company will charge on this company, what the government will charge on this company. Then it is given that the passenger capacity of aircraft is 60 passenger. That a 60 passenger can board on this flight, and the expected operational capacity is 80%. So means although 60 passengers can board this flight, but the expected operational capacity is 80%, means more or less on an average basis we can say 80% of 60 means 48 people are going in one trip. So you can understand. So expected operational capacity is 80%. It means that although the this flight the flight what they bought for 5 crore rupees, it has the capacity to take 60 people, but on an average basis around 48 people are going in one trip, and per aircraft number of trip on a daily basis is 4. So every day it goes on four trips. So 4 trips every time 48 people are going, every time 48 people are going, and it is going 4 trips. So means how many people are going in a day? So 48 Forza. So 48 Forza, I believe is 192. So 192 people are traveling in a day. Okay, so 192 into 365, assuming that it goes like you can assume, because they have not given the working days or something. So I'm assuming it is working all the 365 days in the year. So you can calculate that 48 into 4, that is 192. 192 into 365, that many people are going in a year. Okay, and average realization per person passenger is 2000 rupees. So average from every person they take 2000 rupees. Okay, so that way you can calculate the revenue what the company generate in a year. So that would be 80% of 60 into 4 into 365 into 2000. That is the total revenue what the company is generating for a year. Then the data is given annual cost of manpower. So annual cost you understand. So for like it's around 2.5 crore. Then airport handling charges, which is per day basis it is given. So annual cost of manpower, that is given for the year data, and airport handling charges is given per day basis. So this I'll calculate 10,000 into 365 to determine per year airport handling charge. Then annual repair and maintenance is given to 5 crore, and daily operational cost is 75,000. So this 75,000 I'll multiply with 365 to determine the annual operational cost. Then it is given that the cost with the exception of airport handling charges are expected to increase 10% year on year. So except airport handling charge, which is 10,000 rupees per day, except that other cost would increase every year by 10%. Okay, and the operational capacity would go up by 90% from year two. So, and the operational capacity would go up by 90%. So, the operational capacity would go up by 90% from year three. So, from year three, the operational capacity means earlier the operational capacity was 80%. Now from year three, it will go up by 90%. So 90% means 90% of 60 means 54. So it will become 54 from the third year. Okay, so then it is given that the certainty of achieving the projected cash flow in the first 5 years is given this. So this is given zero point 0.8, zero point 0.9, 5 year data is only given. So although the life of the aircraft is 25 years, but they have given in this problem the data for only 5 years. These are certainty equivalent, and the present values are given. So what are these present value data? So what are this 1 minute? Let me cut this part. So what? Just ignore it. So I want to explain this. So So what they have mentioned here, see this, two things, a few things I want to explain this if you have doubt. So if you remember, the cost of capital was 16%. I hope you remember that the cost of capital was 16%. So the cost of capital was 16, that you remember, that cost of capital was 16%, you remember. Now the present values for 5 years. These are the present value for 5 years. What they are all about. So this is about this value is 1 divided by 1 plus 16% for the year one. This value is 1 divided by 1 plus 16% for year two. This value is 1 plus 16% for the year three. I hope you are understanding. So I hope you understood this value would be 1 divided by 1% for the year four, so that you don't have to use calculator. Okay, so this is what they have given. So they want us to calculate only for 5 years and all. So the examiner want us to do all our analysis only for the 5 year data. Okay, then the next thing uh, is called this the next thing is called as certainty equivalent. The next thing is called as certainty equivalent. So what is certainty equivalent? I'll explain you what is certainty equivalent. So what is certainty equivalent? I'll explain you. So for the first 5 years, the certainty equivalent is given to you zero point 0.8, zero point 0.9, 0.75, 0.7. So what do you mean by this certainty equivalent? Let's try to understand this. See, what happens that you understand these all what all discussion, what all we are doing here right now, we are doing based on our assumptions. Okay, so you understood the assumption. Assumption is that although the operational capacity of the aeroplane is 60, but only 80% will be board, and every day they'll make 4 trips. Okay, and then the cost data, we have projected that annual cost of handling would be this much. All that we have assumed, and then we'll start calculating. So how will we calculate? First we determine the revenue. From the revenue we deduct all our cost. Okay, and then we pay our taxes. So tax applicable or not applicable. So whatever the profit we get, we add depreciation profit. So once we add depreciation on the profit, we'll get cash flow. So once we get the cash flow, so once we get the cash flow, this cash flow would be the important parameter for analysis. So whenever we do analysis on the capital budgeting, so there we look into the NPV, IIR, or discounted payback, or we look at profitability index, all these tools to analyze the capital budgeting decisions. So the very important tool is to work on is the cash flow. Now you need to understand there's a term whenever we do risk analysis on capital budgeting. There's a term called certainty equivalent. So certainty equivalent basically gives you value between 0 to 1. Certainty equivalent basically gives you a value between 0 to 1, and this value basically talks about how much you are sure. Certainty equivalent, so how much you are sure that you get that much cash flow. So if I'm saying the cash flow for year 1, if I'm saying the cash flow for year 1, if I'm saying the cash flow for year 1 is x rupees. So if I'm saying the cash flow for year 1 is x rupees, so what is certainty equivalent? Suppose certainty equivalent is 0.5. So it means that what this means, it means that you are 50% sure that you will get X rupees cash flow. So what we do, there's a calculation. So in exam also, if you see your question paper, every year around one question comes on certainty equivalent. So what basically we do, so whatever the cash flow you are expecting, no, this X rupees, we multiply the certainty equivalent with the cash flow. Okay, so we multiply the certainty equivalent with the cash flow, and that we discount with the WECC every year. So if you want, so this is another risk management technique which you can follow. So to analyze the capital budgeting decision. So every year, because you're estimating the cash flow, so whatever the cash flow you estimate, you put one more what you say, you put one more filtration to very sure about the cash inflow. So you multiply the cash inflow what you're expecting with the certainty equivalent, and then you determine the sum total of your cash inflows. Then you determine the sum total of your cash inflows. This is again one of the tool. This is again one of the tool to analyze the capital budgeting decision. Just one of the tool. So this is also one of the tool to analyze the capital budgeting decisions. We'll discuss about certainty equivalent. There are a lot of tools to analyze the capital budgeting decision. When you work on the risk analysis, there are a lot of tools. Certainty equivalent is one of the tool which we can use. Fine. Now, so you understood this problem all about. Now we'll try to solve this problem. Now we'll try to solve this problem. You can see this. So so now you can see this. You can see the cost of turboprop engine is 5 crore. This is 5 crore rupees. The cost of turboprop engine is 5 crore rupees. Then depreciation is calculated on straight line method. So your depreciation would be 20 lakh. Okay, so 5 crore divided by 25. cost of capital is 16%. Okay, so no tax for the first 3 years, and then the tax rate is 30%. That is given in the problem. So that is given in the problem. You can see uh, here that it enjoys a tax waiver. It enjoys a tax waiver of 100% for the first 3 years. So no tax for the first 3 years. Okay, and then okay, so daily it is given that daily it goes 4 trips. So one trip means number of passenger is 48, and this is for the first 2 years. Okay, this is not for first 3 years. This is for the first 2 years. So daily 4 trips it is going, and one trip means 80% is the operational capacity efficiency. The operational efficiency is 80%. So their operational efficiency is 80%. One trip means the number of passengers which are going is 80% of 60, that is 48, and the total number of passengers which are going is 192 for the first 2 years. Okay, so 4 trips it is doing. So every time 80% of 60, 48 people are going, and if it going 4 trips, so total number of passenger would be 192. Then annual realization per passenger is 2000 rupees. So the total revenue per day, that would be 2000 into 192. That would be 3,84,000. That is for the first 2 years, not for 3 years. That would be for the first 2 years. And because from third year, the operational efficiency become 90%. And then the total revenue per day from third year. So the total revenue per day from the third year, so that would be 2000 into 54, because 90% of 60 is 54 into 4, daily 4 trip, that would be 4,32,000. And I'm assuming that they have 365 days working. So that part they have not given how much their days they are working in a year. So that you can assume 365. Many places weekend, I don't think aeroplane works on that system that they don't work on weekend. I believe aeroplane works all every day. So assuming year has a 365 working day, so I'm ignoring the concept of leap year. So the total revenue, this would be the total revenue for the first 2 years, not for the 3 years. So this would be total revenue for the first 2 years, and this is from third year. This is from third year to 25 years. This is the total revenue. I hope you understanding this. And anyone have any doubt? Anyone want to ask anything? Any doubt? Anyone? Please write in the message box. Anyone want to ask anything? Anyone want to ask anything? Okay, so I guess no one have any doubt. Okay, fine. So going further, so you can see this. So this is total revenue. So okay, 1 minute. So from third year, this is happening. So now see this. So total revenue for the first 2 year, you got this figure. How I got this figure that I explained you. So this for the first 2 year, this is the total revenue for the first 2 year. You can see this. This is the total revenue for the first 2 years. So this is the total revenue. This is for 0 year. This is the total revenue for the first 2 year. Then the annual cost of manpower. So annual cost of manpower that is given 2.5 crore. Annual cost of manpower, it is given 2.5 crore. So then it is increasing every year by 10%. Annual cost of manpower, it is increasing every year by 10%. So Manju, it is given in the problem. It is given in the problem, Manju, that that the you can see this, that the operational efficiency will increase by 90% from year 3. So it is given. So for the first 2 years, the operational efficiency is 80%, and then from year 3 it is increasing by 90%. So 80%. So the passenger capacity for the aeroplane is 60 passenger, and so for first 2 year that would be 80%, means 48 for the first 2 year, and then from third year it become 90%, means 54 passenger. So so that's why I did this. So first 2 year. So then for third year, this would be the revenue. So although I did for all the 25 years, I did all the 25 years. So for your exam point of view, you just need to do for first 5 year. Okay, so this would be the first. This would be revenue part. I think everyone understood. Then annual cost of manpower is 2.5 crore. So that is 2.5 crore. So this when you see this, so when you see this 2.5 crore annual cost of manpower, when you see this as a 2.5 crore, then it is increasing 10% every year. So that is given in the question, that all the data will increase by 10%. So that is given in the question, that all your data, the cost with the exception of airport handling charges, are expected to increase by 10% year on year basis. So except the airport handling charge, except that everything will increase by 10% year on year basis. So that's why this was 2.5 crore, and then I increased it by 10%. Okay, then I increase it by 10%. So again, every year I increase it by 10%. Okay, then airport handling charge is constant. Okay, so airport handling charge will not increase. So airport handling charge is given to be 10,000 rupees per day. So airport handling charge is given to you 10,000 rupees per day. So for a year, so I multiplied that with 365, and that remain constant. So that remain constant all the 5 year. Then annual repair and maintenance is given 5 crore for the year, and every year it will increase by 10%. So that I have done. So then operational cost is given per day basis. So operational cost is given, daily operational cost is 75,000 rupees. Daily operational cost is given 75,000 rupees. So I multiplied that with 365. I multiplied that with 365. So to get per year operational cost. Okay, then it increased by 10% every year. So that I have done. Once I've done depreciation, your depreciation is your non-cash expense. So depreciation, that is straight line, and no terminal value is given. So depreciation is 20 lakh rupees. So every year depreciation would be 20 lakh rupees. So then I added all these figures. I added all these figures. I added all these figures. These are they are your cost. So I added them. So these are your cost. So I added them. So I added them. Then you got these are you got the sum. Once these are the sum of these data which is given in yellow color. Then then I calculated the earning before tax. So the earning before tax is nothing but your earning before tax is nothing but, if this is column one, if this is suppose if this is column one, and this is so 2, 3, 4, 5, 6, 7. So this is 7. So earning before tax is 1 minus 7. So earning before tax is 1 minus 7. I think everyone can understand what I'm talking about here. No rocket science we're discussing. So earning before tax is your total revenue minus your total cost, including depreciation, that I'll subtract. So I'll get this as a earning before tax. Okay. Then you can see here. So what I have subtracted here. Uh, so that you can see what I subtracted here. So this is your earning before tax. Now, then for the first 3 years, there will be no tax. So government told that for the first 3 years, no tax for you. So that's why no, I did not charge any tax. Then tax rate would be how much? 35% or what? Then your tax rate is 30%, that you can see for the first 3 year no tax. Then after that they are charging 30% tax. So that is given in the problem. So this is given in the problem that for the first 3 year no taxes. Currently, it is operating on a 30% tax regime, and under the new government scheme, it enjoys 100% tax waiver for the first 3 year. So I did not charge tax for the first 3 year. I did not charge tax for the first 3 year. I did not charge tax for the first 3 year, and then I charge tax for the 30% tax. Okay. So then profit after tax. So profit after tax is what, 70%. Okay. So for the first 3 year, earning before tax and profit after tax are same, and then 70% of your earning before tax. Okay. Then cash flow from operation would be profit after tax plus depreciation. So the cash flow from operation would be your profit after tax plus depreciation. So with that, I got the cash flow from the operation. So with that, I got the cash flow from the operation. So I got these cash flow. Then you remember, no, certainty equivalent was given zero point 0.8, zero point 0.9, 0.75. You remember 0.7, zero point 0.7. So that I multiplied with the cash flow. So that I multiplied with the cash flow. So that I, because that is given, so I have to use it. So that I have multiplied with the cash flow. So I'll explain about certainty equivalent. We'll do some numerical on certainty equivalent after this. After this, we're done with this problem. So then certainty equivalent is given. So we multiply the cash flow with the certainty equivalent. So I gave a name for this. So the cash flow from operation after adjustment of certainty equivalent. Some name I've given for that. So some name I've given for that. So I multiplied them. So once I multiplied them, then discount rate is given. So 16%, all this discount rate is given. So you don't have to use calculator, scientific or anything. That is already given. So you can use that, but I have not used it for multiplication part. You can use the discount value. Then I determine the present value. I believe everyone knows by this time how to determine the present value. And also present value is future value divided by 1 plus discounting rate to the power n. So with that, I determine the present value of the cash flow. There I took the discounting rate as 16%. For the 5 year, I have done that because they want us to do for the 5 year. So I did for the 5 year. So I did for the 5 year. So I did for the 5 year. So once I did for the 5 year, so then initial investment, you know, that is 5 crore. So then I calculated my NPV. So this is my NPV. So NPV is my initial investment minus the sum of present value of the future cash flow. So because in exam, when I am doing in notebook, I cannot do for 25 years. Then all the three hour will go for 25 year calculation only. So I think that's why they have given only 5 year data. They want us to calculate on 5 year, because in exam we cannot do 25 year. Right now I'm doing in Excel, so I can do on 25 year. But if I'm doing in exam, I cannot do on 25 years. So it will take a lot, like it will take around 3 hour only for doing this in exam if you do like that way. So that I don't know, whatever purpose what is given, so we are doing that. The NPV for the project would be around this. This is what I'm getting as an NPV. Clear? Anyone want to ask anything? Anyone want to ask anything? As you can see also here, you start getting losses from 6th year. Anyway, from 6th year, you're getting loss only. So only till 5 year, the profit is there. Then after 6 years only losses are there. That is again reason they don't wanted us to do on from 6 year. You can see here, I have done the calculation for all the 25 years. You can see from 6 year they are getting losses only. Anyway, so whatever is given the problem, our objective is to do that and we are doing it. Anyone want to have any doubt, any question you want to ask? Anyone, any question, anything you want to ask? Anyone, any question? Cash flow from operation is profit after tax plus depreciation, Manju. That is called as operating cash flow. That is your profit after tax plus depreciation. So when you add depreciation or non-cash expense on your profit after tax, you get the operating cash flow. Anyone, any doubt, anything you want to ask? Harish, how are you? Any Harish, any question? Are you understanding? Ranjit, any doubt? Darshan, Mallikarjun, Manju, Monisha, Nandita, Roja, Silpa, Shiv Prasad, any doubt? Amit, any doubt? Okay, so I guess you don't have any doubt. So let's understand certainty equivalent because this term came called certainty equivalent. So let's try to understand this term called certainty equivalent. So so basically when you do the risk analysis, so basically when you do the risk analysis on capital budgeting, we use different terms. We use so terms can be a risk adjusted discount rate, the terms can be a certainty equivalent, the terms can be sensitivity analysis, scenario analysis. So a lot of terms are there whenever we work on risk analysis or capital budgeting. So one of the term is called certainty equivalent, one of the term is called as certainty equivalent. So let's understand certainty equivalent. So if you want to understand certainty equivalent, 1 minute. So guys, so you these two should be clear. Normally, students get confused between these two terms. One is called risk-adjusted discount rate, and another is called certainty equivalent. So please understand these two terms. So what is risk-adjusted discount rate? You can understand risk-adjusted discount rate if you want to understand. Uh, color. 1 minute. So no color I can use. So you can see this line. You can see this line. The line written in bold letters. A risk adjusted discount rate is the sum of risk free rate plus risk premium. So you know the NPV calculation and all. So in NPV calculation, you know that in NPV calculation, whatever the future cash flows expecting, we discount the future cash flows with a discount factor that sometimes is called a WACC. So the different terms, different name you can use for that. So you can so to analyze the risk, if you want to put all the risk what your firm is facing or a single factor. So one of the factor what you can put the burden of all the risk what your firm is facing on a single factor that can be a discounting factor, that is your risk adjusted discount rate, that is the sum of your risk free rate plus risk premium. Okay, anyone, what is risk free rate? Anyone, what do you mean by risk free rate? What do you mean by risk free rate? Anyone, what is risk free rate of return? If I say RF, right now the risk free rate of return is 8%, what that means to you? Anyone? You studied CAPA model, capital asset pricing model, you remember, right? So risk-free rate of return is the minimum return what you can get on your portfolio without taking any risk. Like if you put your money in bank MD or if you do investment in government bonds, okay. So if you put your money in post office or bank MD or maybe any other scheme where there's no risk, where the returns are guaranteed. What is risk? What is risk free? Risk free means no risk, means your returns are guaranteed, like where your returns are guaranteed. So what is the maximum return you can get? So if you put your money in Yes Bank also, Yes Bank for your saving bank account gives 7% interest. Kotak Mahindra Bank gives you 6% interest. So this 6% interest what the Kotak Mahindra Bank is giving you, or the 7% interest what the Yes Bank is giving you, or your saving bank deposit is the risk-free rate. Okay, so without taking any risk, minimum that return you can get. So you remember, right? CAPA model. CAPA model means your expected return is equal to RF plus beta into RM minus RF. So that means your return, what you're getting is equal to RF. RF means risk-free rate plus beta into RM minus RF. So beta into RM minus RF, it basically talking about the risk premium. So beta is the factor which talks about the risk. How much risk you can take, that much return you can get. RM minus RF. RM minus RF. RM is the market return. So according to the efficient market hypothesis, you can never beat the market. So the return what the stock market, what the return what the NSE or Sensex or Nifty is giving you, that is the benchmark return. So benchmark return minus the risk what you are taking. So more risk you take, more return you get. That is what CAPA model is all about talking about. So the same thing we use for the risk adjusted discount rate. So more or less it be the same thing. So it's not a hypothetical, Manjunath. A risk-free rate is not at all hypothetical. It's real. So basically, when we say risk-adjusted discount rate, so a risk-adjusted discount rate basically means, so the discounting factor what you're using, in that you try to put all the forms of risk what you can have on a single factor. The same thing what CAPA model has also taught us. So that can include the compensation for inflation, that can include the compensation for delayed consumption, all that, what all you can put on a single factor. You try to put all the forms of risk on your investment on a single factor, and that you add with the RF, and then what you get is the risk adjusted discount rate. And then whatever the cash flows I'm expecting, I discount my cash flows with this risk adjusted discount rate. Okay, so I hope you are understanding. This is called risk adjusted discount rate. And then so then you can read this about what I'm talking about. Please, everyone, please read this. So it's self-explanatory. Okay, then so then going further, so correct, correct, Mallikarjun. So that without taking any risk. So if you put your money in bank FD, or if you put your money in saving bank account, anything where you don't take any risk, no risk, no risk. So means your returns are guaranteed. So that is what CAPA model also talks about. CAPA model also talks about the same thing. So the return what you get on the market, the return what you get on the market. So it follow this formula. This is your RF. This is your RF. So after that, more risk you take, more return you can get. Okay, so here your risk is zero. With zero risk, what is the minimum return you are getting? That is your RF. Then more risk you take, more return you will get. Okay. So then going further, so you can see that. Then the next factor, what you need to understand is the certainty equivalent. This is what in your exam numericals also come on that. So I could have directly told you the numerical, but before I have thought to directly do the numerical, I just want to discuss little bit of theory on that part. So certainty equivalent, what do you mean by certainty equivalent? So it involves expressing the risky future cash flows in the term of a certain cash flows which would be considered by the decision maker as a equivalent. That is, the decision maker would be indifferent between the risky amount and the lower riskless amount considered to be equivalent. So certainty equivalent is the guaranteed return that the management would accept rather than accepting a higher but uncertain return. Okay, this approach allows the decision maker to incorporate his or her utility function into the analysis. In this approach, a set of riskless cash flows is generated in place of original cash flows. So what you basically do in certainty equivalent, so whatever the cash flows you are expecting, you multiply that cash flows with a factor between 0 to 1. So more closer to 1 means more you're sure about the cash flow you are getting. So it's like a probability only, you understand. It's like a probability, it's more or less like a probability. So whatever the expected cash flows are there, you multiply your expected cash flow with that factor. Okay, and then whatever the value what you get, you discount it with a risk-free rate of return. This is very important thing, guys. So that here we divide it by the discounting factor. What we use is the risk-free rate, because all the risk already we have taken into certainty equivalent. So when I say certainty equivalent, all the risk that I have put in that value between 0 to 1, and then I discount this with RF, that is risk-free rate. So remember this. So this is not divided with the risk adjusted discount rate. So this is divided with RF, risk-free rate. So why I'm telling you this again, why I'm telling you this risk-free rate again, because you understand certain time in exam they'll try to confuse you. So if you see the numerical here, if you see the numerical here, if you see the numerical here, so if you see the numerical here, so here they are trying to confuse you. So if you see the numerical here, so the theory part, left the theory part, then if you see the numerical, so they have given you the year 0 to 5, they have given you the expected cash flow, they have given you the certainty equivalent, and then they have given you three discounting rate. They have given you the cost of equity, they have given you the cost of debt, and they have also given you risk-free rate. So then the people get confused. Sir, what should I take? Like a risk-free rate is also given, cost of equity is also given, cost of debt is also given. So what should I take, sir? Should I first calculate the WACC? Should I first calculate the WACC or cost of capital? Cost of capital is the sum of cost of equity plus cost of debt. So should I calculate my cost of capital and then should I add the cost of capital with RF to get the risk adjusted discount rate? Then I discount it? No. So the reason why I've given you this theory, the purpose of giving that theory is to make this clear in your mind that whenever there's a problem on certainty equivalent, whenever there's a problem on certainty equivalent, you will discount your expected cash flow after adjustment of certainty equivalent with RF. RF means risk-free rate, and risk-free rate here is given 6%. So the data of cost of equity and cost of debt is irrelevant here. Okay, so you can see this. So 1 minute. So you can see this. So you can see this. So here you can see in this problem. So what requires here is the risk-free rate. If you really looking for a discounting factor, then you should see only one factor, that is the risk-free rate. Okay. So this is the reason why I've given you the theory part of this. And one more thing I just wanted to add on the theory, that out of these two factors, which is a better factor, risk-adjusted discount rate or certainty equivalent? So certainty equivalent method is superior to the risk adjusted discount rate method, as it does not assume that the risk increases with time at the constant rate. Each year the certainty equivalent coefficient is based on the level of risk impacting its cash flow. Despite its soundness, it is not preferable like risk adjusted discount rate method. It is difficult to specify a series of certainty equivalent coefficient, but simple to adjust the discount rate. So you understand, out of a risk adjusted discount rate and certainty equivalent, you should prefer, like, which one should be preferred logically? It should be certainty equivalent is superior to the risk adjusted discount rate. Okay, keep that in your mind. Now based on this, we'll do the numerical. So based on this, we'll do the numerical. So this is the numerical what we'll do. Okay, so let me just let me use the Excel for this. Or I'll do this on notebook. Let me do this on notebook. So these are your cash flows. So this is your expected cash flow. So what you will do now, multiply this. So find this. So what term can I use for that? 1 minute. What should I write for this? Okay. Certainty equivalent coefficient. Okay, then nothing. Okay, fine. So that is not given. So let it me. So I'll give a name for this. So name is expected cash flow. Expected cash flow after tax with adjustment of certainty equivalent. Okay. Okay. Then so this would be minus 2 lakh. This would be minus 2 lakh. So this would be minus 2 lakh. Then minus 2 lakh into 1. Then it would be 1,60,000 into 0.8. 16 8 is 128. So this would be 1,28,000. Then 1,40,000 to 0.7. 14 7 is 98. So this would be 98,000. This would be 98,000. Then 13 6 is 78. So then this would be 78,000. Then 1,20,000 to 0.4. 12 4 is 48. So 48,000. And then 80,000 to 3, that is 24,000. So you got for the 5 year this. Now your here the discounting factor what you will take is here the discounting factor what you will take is RF. Here the discounting factor what you will take is RF. RF is given 6%. So RF is given 6%. So your NPV, your NPV will be minus 2 lakh. Your NPV will be minus 2 lakh plus 1,28,000 divide by 1 plus 6% to the power 1 plus 98,000 divide by 1 plus 6% to the power 2 plus 78,000 divide by 1 plus 6% to the power 3 plus 48,000 divide by 1 plus 6% to the power 4, then 24,000 divide by 1 plus 6% to the power 5. And then I'll calculate this value and that would be my answer. Anyone have any doubt? Anyone want to ask anything? Anyone have any doubt? Anyone want to ask anything? So anyone have any doubt? So now I'll calculate my NPV. My NPV is minus 2 lakh plus 1,28,000 divided by 1 plus 6%. That would be 1,20,000, 1,20,754.716716 something plus 98,000 plus 98,000, 98,000, 1 minute. So 98,000 divided by 1.06 divide by 1.06. So that is 87,219, 87,219.6511. You can do this. I believe no one have any doubt. Then this 78,000, then 78,000 divide by then 1.06, 1.06 to the power 3, that would be around 65,490 point 3040. Anyone have any doubt what I'm doing? Anyone want to clear anything? Just let me know. 48,000 divide by 1.06 to the power 4, to the power 4. So that is 38,000, that is 38,020.4958 plus then it was 24,000, then it is 24,000 divide by 1.06 to the power 5, to the power 5, no, to the power 5. So if I, that is 17,934, that is 17,934.19.1916. So this value what I get, I add this value. This is 38,020.4958 plus 65,490.304 plus 87,219.6511 plus 1,20,000 754.716 plus sorry minus, now this will be minus. So okay, leave this. So this is 3,29,419. If I subtract this with 2 lakh, 1 2 3 4 5, so I'll get 1,29,000. So my NPV I'm getting as 1,29,000, 1,29,419.3630. This is what you are getting as NPV. Okay, so anyone have any doubt? The purpose of doing this like this is to develop confidence in you people. So, so ultimately, exam you have to do in notebook only. The reason this is therefore for make you people understand, to make you people comfortable with the concept. I'm doing like that way. So anyone want to ask anything? Any doubt anyone have? This is a concept of certainty equivalent. Remember only one thing, that you discount this whenever you do calculation of certainty equivalent. You discount the certainty equivalent at the risk-free rate of return. Okay, so don't get confused with other discounting rate if it's given in the problem. You will discount this whenever it's given. You will always discount it with your RF or risk-free rate of return. Clear? Any question? Anyone? Anyone want to ask anything? Anyone? Any question on certainty equivalent? I'll put in the group, Ranjit. Theory part PDF I'll put in the group. You can read that to understand the concept. Because theory is also important. Now see the next question. Anyone else? Anything? Anything else? Anyone? Manjunath, you want to ask anything? Now see another question. There's a company called uh, RK Limited is considering the investment in one of the two mutually exclusive proposals. So project A involves a cash outlay of 1,70,000, and project B, which is an outlay of 1,50,000. The certainty equivalent approach is employed in evaluating investment is given to you. The current yield on the treasury bill is 5%, so that you will take as a RF, and the company uses this as a riskless return. The expected value of net cash flows are given to you. So which project is acceptable to the company? So that you can decide very easily. So which project is acceptable to the company? If you want, we can do this calculation. Mm, mm, So I'll write down this data. So if I say year 1, 2, 3, then your cash flows and certainty equivalent is given to you 90,000. 1, 2, 3, 4, then 1 lakh, 1, 2, 3, 4, 5, then 1,10,000. 1, 2, 3, 4. Then certainty equivalent is 0.8, then 0.7, and then 0.5. So this is given to you as a certainty equivalent for this two firms. So So now what I'll do, I'll do cash flow after certainty equivalent. Hmm. So this is 90,000 into cash flow. So you get the cash flow after certainty equivalent. You multiply the cash flow with this. Okay. So then what I can do, I can find the NPV. So discounting factor is 5%. 5% is your discounting factor. So the RF you will take as 5%. 5%. 5% you will take the RF. So you will determine the present value. The present value of this would be the 72,000 divided by 1 plus 5% to the power 1. So like this you calculate for all. Okay. So the sum of this is 1,79,576. That is a good thing about Excel. You don't have to do manual work, but I don't wanted to do everything with Excel. Otherwise, many people will think that in exam you have to do in notebook. So why sir is doing in Excel? So you need to understand. I hope you are understanding. So either I do on Excel or notebook, you can easily understand that you can easily solve this. So I'm just trying to avoid the time because time is very critical. So I'm just doing this like just to save our time. So this is the sum what you get for project A, and you can see the initial investment for project A is 1,70,000. So that is 1,70,000. So initial investment for project A is 1,70,000. One, two, three. That is 1,70,000. So you can find the NPV. The NPV is 1,79,000 minus 1,70,000. So that you got the NPV of project A as 9,574. This is the NPV you get for project A. Okay. Similarly, I do for project B. So NPV for project A, the NPV of project A, this is 9,574. This is the NPV of project A. Now I can find the NPV of project B. That is 91 lakh. So 91 lakh. This is 1 lakh. I can put it here. 1 lakh. I can put it here. And 90. I can put it here. 90. I can put here. Certainty equivalent is 0.9. Then 0.8. And then 0.6, then 0.6. Rest everything is same. So you can see the and then initial investment of project B is 1,50,000. This is 1,50,000. So you can see the NPV of project B. So NPV of project B that is around 44,000. So you can see the NPV of project B. So that is around 44,000. So out of A and B, which one will you prefer? Out of A and B, which one will you prefer? You will prefer the project B because project B is giving you the more NPV. I hope you understanding this. Now, what I can do, then what they are talking about, okay, fine. So which project should be acceptable to the company? So the company should accept the project B. Anyone any doubt with this? Which project is more riskier? Out of A and B, which project is riskier? How do you know? So, so which project is riskier out of A and B? You can easily understand that A would be riskier. You can easily understand that the A would be riskier. Why A would be riskier? Because A and PV is also less, and the initial investment what the A is taking also very more. A is charging A for doing a project A. You need 1,70,000, and the cash flows are variable. You can see the cash inflows what you're getting for A is variable. while for B, the cash inflows, what you're getting is not at all variable. So for more or less, it is constant. So which project is riskier? So definitely the project A is riskier because the capital investment what require is more, but at the same time the NPV is less. At the same time, the cash flows are very variable. So if you want to waste time, because this is 6 marks question, I don't want you to waste your time on that. I really don't want you to waste your time on that. Otherwise, if you really want to go one step further, what you can do, you can calculate the standard deviation. You can calculate the standard deviation. So the standard deviation summation of x minus x bar whole square by n, or you can use standard deviation summation of x square by n minus x bar whole square. So you can use any of these formula of standard deviation on both these cash flows. So you can use any of the formulas for standard deviation on both these cash flows, and ultimately the project A standard deviation will definitely would be more than project B standard deviation. I hope you remember in first semester we have done a lot of problem standard deviation. So you can, to measure the risk, which one is more volatile, you can use standard deviation. Okay, so standard deviation in Excel I can do directly, so that is a good thing. So in a standard deviation in Excel, I can do directly. So, so you can see this. So the standard deviation of project B. So the standard deviation of project B you are getting as 4714. So this is the standard deviation of project B. So this is 4714. Similarly, if I want to calculate the standard deviation of project A, 91 lakh, 91 lakh, 1 lakh 10,000. So 91 lakh, 1 lakh, 91 lakh, 91 lakh and 1 lakh 10,000. Then zero, then how much zero? 3 zero, 1 lakh 10,000. So you can see the standard deviation of project A. So you can see the standard deviation of project A that you are getting as around 8164. So that you are getting as around 8164. So with this, I see, I just, for you people, I'm just trying to prove this. If you want, I can calculate also on this. So I can waste my time doing this calculation. So if you want, I can do that also. But I don't think that would be much relevant because this is just a 6 marks question. Just to prove that the fact I just did this. So in exam, I really don't suggest you for the 6 marks question to do all this standard deviation calculation. You just mention this and write down the formula. That would be more than enough, because this come for how many marks? This come for 6 marks, 5 marks question. This is not 6 marks. This is just a 5 marks question. Then part C of the question: if the company was to use the risk-adjusted discounted method, which project would be analyzed with higher rate? So which project will you analyze with higher rate? The project which is more riskier. So which project is more riskier? Definitely the project A. Okay, so which project will you analyze with higher rate? You analyze the project A with higher rate because that is more riskier. Already I proved that part. Okay, so anyone, any doubt, anything you want to ask? Anything anyone want to ask? Any question, guys? Darshan, Mallikarjun, Manjunath, Monisha, Ranjit, Roja, Shilpa, any question? Any question, guys? So you understood, right? So this much for the today class. So then we'll meet on Monday to continue further. I hope you like the class. If you like the class, please forward to your friends who are in there in other MBA colleges and those who are taken finance. So please forward these videos to them so that everyone will get benefited. Any doubt, anyone? Okay, guys. So I believe you are clear. No one have any doubt. Any question you want to ask? Feel free to ask anytime. Okay, guys. Then we'll wind up the class. Happy weekend, everyone. God bless you. Take care. Take care of your family, your health. See you very soon on Monday. Thank you, everyone. Mm, take care, Monisha. Everyone, take care. God bless you. See you next class. Bye. Thank you. Thank you, everyone.